Live from Tokyo, I'm Sherry-Ann. This is Insight, where we dive deeper into the stories that matter with crucial context and analysis. Rising fears about artificial intelligence pummeling shares of companies that could be caught on the wrong side of rapid technological change. The latest sector facing disruption is wealth management, following in the footsteps of software makers and financial analysts. We'll ask if the AI fears are overdone or a genuine taste of things to come. Robeco Asian Equities Portfolio Manager Vicki joining us with her views on a highly momentum-driven market. We're live at Consensus in Hong Kong with Robinhood VP Johann Kerbrat as the slide in cryptocurrencies bites into earnings. Plus, Solana Foundation President Lily Liu will tell us why blockchain needs to shift focus back to its original purpose, finance. Also ahead, China's factory deflation easing more than expected in January thanks to higher commodity costs and a crackdown on excessive corporate competition. And we get a reading on consumer demand in India and the outlook for precious metals with the CFO of jewelry and fashion company Titan as their quarterly profit misses estimates. Take a look at how we're looking Equity markets broadly higher in the Asian session around midday right now. We're seeing MSCI EM stock indices rising to fresh record highs. This as we're seeing the MSCI Asia Pacific Index gaining ground, being led by those materials and tech stocks. We have seen gold prices, silver prices all rebounding in today's session. We have seen the Kospi also gaining ground. We continue to watch some of those chip makers because we had the downside pressure coming from the Wall Street session where we had really pressure on the Philadelphia Semiconductor Index. As I mentioned before, after the software maker sell-off, we had brokerages selling off. Now is a turn of wealth managers, all to do with that artificial intelligence disruption theme that continues across markets today, and perhaps a hot new trade now for investors, dumping any stock seen as vulnerable to AI disruption. Shares of Schwab, Raymond James, and LPL Financial falling 7% or more after startup Altruist unveiled a tax strategy tool called Hazel. Some say the fears could be overblown as software names rebound from last week's sell-off, but analysts warn that the reaction shows how jumpy markets are after a long AI-driven run. For more, we're joined by Bloomberg tech co-anchor Annabelle Drewlers, live from Consensus Hong Kong, where crypto, Web3, and AI all in focus today. Annabelle, so what a time to be at the event. But just first of all, set the scene for us. How is the industry reacting to these AI disruption concerns?
Yeah, it's been a really interesting move overnight, rather, and one that seems to have caught a lot of people off guard, especially when you just mentioned some of those stocks. For instance, Charles Schwab is the only one that has a sell rating. So the strength of that downturn, again, it may be a bit of a shock to some, but essentially it just is the latest industry here that's really being caught in the AI crosshairs. And what exactly has prompted that selling is a new tool, essentially, that's been unveiled by Altruist. That's a closely held tech company. But this new tool, as you said, it helps financial advisors personalize strategies for clients, create documents, and is something that, again, it sparked that sell-off frenzy that we saw in a lot of wealth management companies, because there are concerns here around how much can AI do? Is it going to be really disruptive to those bigger business models? So, again, as I said, certainly catching some on the back foot.
At the same time, though, we continue to hear the optimism coming from the likes of NVIDIA CEO Jensen Huang calling that sell-off in software, for example, illogical. David Solomon also saying that potentially that could be a little bit overblown at this point. So what are the positive comments that we continue to hear from people in the sector, and perhaps what could give us an indication of where this disruption might be going?
Yeah, it's been really interesting because I think it sort of just points to that broader, maybe perhaps an evolution that we're seeing in the tech narrative. So at the end of last year, I mean, the biggest concern, and even coming into 2026, was around AI bubbles. It was concerns around circular deals. But it does seem to have shifted in the past couple of weeks, especially after we had that sell-off in software stocks, and really about AI as the disruptor and which industries could it actually look to displace? And the concern here, as I said, is really around disrupting very long-standing business models that have relied on things like SaaS, for instance, that have been high margin, for instance, very consistent revenue drivers as well. But I think you're also seeing that really in that bond issuance and the amount of investor appetite there's been, because Alphabet, of course, is the best example of that this week, and absolutely incredible numbers. I mean, we had that $20 billion of USD denominated debt, but then also overnight they entered into the sterling denominated, also Swiss franc denominated, and again, that demand was exceptionally strong. So, for instance, in the sterling market, they issued a 100-year bond. A 100-year bond, we haven't seen a tenor of that kind of length going back to Motorola in 1997. So we're in the dot-com era here. It's usually a market, essentially 100-year bonds, that's dominated by governments and institutions like universities, for instance. So again, the debt sales we're seeing, biggest issuance ever in these sorts of markets, and it just points to how much investor demand there is still.
Yeah, Morgan Stanley is saying that we could see hyperscalers borrowing about $400 billion or so this year already. But Annabelle, that optimism in the market really not getting translated to what's happening in the crypto space. I mean, that continued turmoil with Bitcoin around that $70,000 mark and not necessarily being able to sustain any gains. What's going on?
Yeah, this has also been an interesting one, and we've been talking this morning. As I said, I'm at Consensus here. It's one of the biggest events on the crypto calendar in Asia each year, and it's back in the city for a second year. But it is an interesting time because last week we had that huge sell-off in trading activity. There's lots of concerns essentially around just the amount of investor appetite there is, about the outflows that we're seeing from ETFs, for instance, and looking at the price action we see in particular, because we were back down to that near that 60,000 level, trading back here around that 70,000 mark. But actually, if you dig into the data, what we're seeing is that a lot of the activity we've had over the past few days has been dominated by Bitcoin whales in the market. So you're talking about investors here that have wallet sizes of 1,000 plus tokens in them. They're the ones that are being most active, adding billions of dollars in just the last few days alone. So sentiment is clearly very fragile still, and you see that very much reflected in the options market as well.
Bloomberg Tech co-anchor Annabelle Drewlers there joining us from Consensus Hong Kong. She'll come back with more conversations as we try to gauge the risk appetite across Asian markets. We've talked about the crypto disruption, AI disruption, and of course, the tech sector under pressure, a lot of volatility. Let's discuss with Vicki Chi, Asian equities portfolio manager at Robeco. Vicki, great to have you with us. We continue to see this volatility in the tech sector. I mean, we have seen software makers coming back from lows that we saw last week. But at the same time, I have to wonder how much of all of this is happening is momentum driven and how much is it fundamental that AI disruption will completely obliterate some of these business models?
It's very exciting times and indeed a bit of a confusion around in the market and in the minds of investors as well. I think the recent proliferation of many of these AI agents, such as OpenClaw, Cloud Code, Menace, has really brought the AI agent into a reality. So what we're actually seeing is the emergence of even a new economy that is the agent community. So these agents have their own identities. They have they would need their IDs. They need their database, even their credit cards, and maybe going forward, compliance and security as well. So this is, I think, what's still missing in this discussion is that people are looking at businesses that could be disrupted, but at the same time, these new opportunities are emerging. So from our perspective, I think investors should be really thinking which business and personal processes are aligned with AI's growth and which ones would be replaced. I would actually think that in financial services, it's relatively safe because money is sensitive and there needs to be a lot of security. So that I think is probably not a real disruption anytime soon. But indeed, I think the software companies that investors really loved with high ROIC, very asset light, and built entirely on IP protection, I think AI would very likely disrupt a lot of that. And the good news for Asia Pacific is that, well, it used to be bad news for us because we don't have that many software companies here. But at this moment, I think we're less risky in terms of being disrupted.
I know. At what point did the narrative shift, right? I just remember a couple of years ago where there was this exuberance over hardware. People were saying, go into software. And all of a sudden, that's not the case anymore. So how difficult is it to position when you don't necessarily know how AI will disrupt businesses? Are there any regions in particular, any markets that could be a hedge in this environment?
I think the other side, the more positive side of this story is really still on the real economy side. So again, Asia's semiconductor supply chain supports the growth of AI worldwide. So this is a great place to be. And within this space, there are still contrarian ideas that can be had. For example, on hardware, I think hardware stocks were destroyed since the third quarter of 2025. And people are having very low expectations because they're afraid of memory prices increases. They're afraid of memory shortages, and NAND has obviously been going up as well. So a lot of these anxieties are in place. At the same time, I think many of us are going out to buy Mac Minis to run these agents. So maybe that is something that the market is still not noticing. And again, it is much easier to replace software by AI, but it is much harder if you think about infrastructure, if you think about whether that's telecom, whether that's power, whether that's grid, a lot of these infrastructure things that would be needed to support AI development, and they are definitely in a net beneficiary of this trade.
How concerned are you about valuations across Asia? Because even the likes, for example, in Korea, Samsung, SK Hynix, they've doubled, tripled the stock price in the last year or so.
Well, share prices look very high and multiples look very low. So we're definitely still expecting a lot of growth. And I think last year, I was also in the studio talking about we're afraid of the AI bubble. But coming into this year with the proliferation of AI agents, I think token consumption is going through the roof for many of the people who are getting into the agent space. So probably this trade still has some to go. And trading at single-digit P for these Korean companies, I don't think that's the most expensive exposure investors should worry about in their portfolios.
What's been interesting, of course, and perhaps not surprising, is given the optimism around tech, around hardware, artificial intelligence, Korean stocks, Taiwanese stocks, Chinese tech also has rallied. But you have seen the likes of, for example, India perhaps lagging. Are those some of the regions that you will stay away just because of the tech narrative leading all markets higher, but not necessarily those that don't have such a big skin in the game?
ASEAN and India has almost become the anti-AI trade in Asia, and I don't think that's justified. So for these markets, I think the key driver would be, again, interest rate direction. So we need the interest rate cuts to come through for these economies. On top of that, I think sentiment is also extremely negative, and like you mentioned just now, the market has been very momentum, so it has been risky to go against momentum. But still, there are very solid franchises in ASEAN and in India, and I think it's definitely a great time to start picking up some of these stocks because, AI trade is going well, but it would have volatilities, and it's good to be balanced in the portfolios.
I love it when the central bank conversation comes towards the end because we're so focused on tech and we forget that, yes, we do still have to watch all of this central bank action across Asia, the fact that the Federal Reserve will get a new chair as well. We've had some surprisingly downbeat data out of the U.S. recently. We're headed towards jobs data. Is this concerning when a lot of the optimism and justification for valuations in the U.S. also rested on the fact that we had a solid U.S. economy?
Absolutely. So 2025 was a year of inflection for Asian investors, because in this year we actually had long-only funds sold $160 billion worth of U.S. equities and deployed about 70% of that in Asia ex-Japan. So this trend is very encouraging for everybody in the region over here. And we believe that indeed the 30% valuation discount is not justified. And with solid earnings growth, we do hope that these flows can continue to come to the region. We are also seeing very positive investor feedbacks that everybody is looking to finally diversify their equity allocations a bit more outside the U.S., and that would be so helpful over here in Asia. And as we have, again, in ASEAN, also in India, many of these beautiful structural growth opportunities that are trading at very depressed valuations.
Vicki of Robeco, do stick around because we also want to discuss the Chinese economy. Coming up, China's factory deflation easing more than expected in January, but its run of contagion extending to 40 extending to 40 straight months. We'll dig into the data next. This is Bloomberg. China's price data showed a mixed picture in January. The consumer price index cooled while factory deflation eased more than expected. Let's bring in our China correspondent, Min Lo. And Min, these are the first China price reports for the year. What stood out to you?
Yeah, certainly not a good start to the year, right? Missing expectations when it comes to CPI, coming in at 0.2% versus 0.8% the previous month. And the scale of the pullback suggests that it seems to be even greater than the seasonal effect as well, because yes, we had a higher base last year because of Lunar New Year falling in January as opposed to in February this year, but still quite a big pullback from the previous month. And PPI as well, an improvement there coming in at negative 1.4% versus negative 1.9% the previous month. But again, that number seems to mask the underlying weakness when it comes to domestic demand, because a lot of that PPI improvement is partly because of the strength in commodity prices, right? Especially things like copper, which has seen prices triple or quadruple over the past few months. So it doesn't necessarily mean that the economy is improving here. So certainly it's something that we want to keep watching, especially when it comes to other data, when it comes to, for example, corporate profits, whether the higher material cost is eating into companies' profits there. And of course, what this means for policy stimulus going forward.
Yeah, exactly, because we heard from the PBOC that they'll carry out, quote, moderately loose monetary policy. So what are the expectations right now for any help coming from authorities?
Yeah, certainly we will be looking out for any potential rate cuts or triple R cuts. Our Bloomberg economics team believes that the first quarter could be a potential window for that, because earlier in January, the PBOC did cut some of the rates for the structural monetary policy tools, but did not cut the main policy rate like the LPR. So we'll be looking out for that. And of course, we are just a couple of weeks away from the two sessions when we will get the government work report from Premier Li Qiang, and that's when he will outline what sort of policy stimulus. We understand that the government is already extending some of these fiscal stimulus, the consumption upgrading program, but the scale seems to be a little bit smaller than last year. And particularly, I think economists are looking out for more support in terms of social safety net. That seems to be quite lacking at the moment as well. So we'll see if the central government will look into expanding some of these fiscal policies.
Bloomberg China correspondent Min Lo there with the latest on all of the economic data out of China. Let's get more market insights with Vicki Chi, Asian Equities Portfolio Manager at Robeco. Vicki, thank you so much for sticking around. Let's start with China. What are your expectations for this market, given, of course, the latest eco numbers that we just got?
I think the Chinese economy remains to be in a consolidation phase. So while the old drivers are still not improving, we're talking about properties, and the new drivers are yet to really emerge to become the powerhouse of the economy. So it is in this process of consolidating, and the hopes are the new economies would actually start to drive the overall economic growth at a certain point in time. So these CPI numbers, I think from month to month, we're tracking them. They're improving very slowly, but it is a gradual improvement.
And to your point on the optimism about a new economy in China, we have seen the Hang Seng tech sector, for example, seeing incredible exuberance. But are the earnings estimates, the performance of companies like Alibaba, Baidu, for example, catching up to those expectations?
I think that's also indeed a difficulty for value investors like me, because I look at some of these earnings and I can't help but feel a little bit less excited about these stocks. But having said that, we're also seeing indeed an inflection on AI taking place right now in China. The Chinese consumers are ordering movie tickets and milk tea from Q1 models that Alibaba is subsidizing right now through Chinese New Year. So these usages, and again, coming back to a little bit on the agent question earlier, the Chinese corporates can adopt AI so rapidly that I think we're standing right in front of the next industrial revolution. And I think in China, especially having very strong power infrastructure and cheap electricity, and these are also very solid advantages going forward. So it's still not entirely clear yet which companies would really be the beneficiaries here, but it's heading towards the right direction.
Well, what's interesting, I read recently from a Bloomberg intelligence report that when it comes to China, AI cannibalization, the concerns that we're seeing about software makers, concerns about the brokerages and all of these new AI tools taking over the business model, that's not as pronounced in China. It's more about just monetizing AI altogether because they've not necessarily really been able to develop a killer app. Is the innovation landscape in China, especially when it comes to producing these transformative tools, can that be a hindrance in the future, especially if you're competing with the likes of U.S. tech giants?
I think the U.S. tech giants all have very beautiful margins, the sort of margins that Asian investors would only dream about. So software traditionally has not been a space where the Asian companies can generate as nice margins as their U.S. competitors. So in terms of being disrupted, there's not that much to get disrupted to start with. And on the other side, I think what's a very interesting angle to look right now would be on the combination of AI and hardware. So we're talking about, there's been some excitement around robotics, but I'm seeing that people are using open cloud to control robot dogs or something like that. So people are trying that. And I think in Asia, there is a fertile ground for bringing this into reality very, very quickly. So at this moment, we're still sitting here, not really having a clear direction. It could change very quickly. Let's say in a couple months, we could be seeing tremendous development already.
Just quickly, Vicki, what are your expectations for those chip makers and hardware in China as well? We saw SMIC missing because of memory chip prices.
I think China is definitely investing for the equipment, for the missing parts in the supply chain that it cannot produce itself. And that is a process that cannot be speed up very quickly. So it will take time anyway. So at this moment, I think is for global supply chain, it is a fear that the Chinese would come in. But actually, in terms of output, in terms of going through the learning process, it still has to continue.
Vicki Chi, really good to have you with us. Thank you so much for joining us. Asian Equities Portfolio Manager at Robeco. We'll have plenty more ahead on Insight. This is Bloomberg. Welcome back. You're watching Insight. Take a look at these two stocks that we're tracking across Asia. In South Korea, Samsung rebounding from losses earlier, although SK Hynix continues to be under pressure. We have seen the Philadelphia Semiconductor Index in the overnight session losing more than 4%, so the broader sector was already under pressure. Not to mention that we had seen some concerns about new Chinese entrants in this space, especially memory manufacturer CXMT in the morning. But then in the afternoon, we had the likes of executives from Samsung speaking at SEMICON Korea, showing really enthusiasm and confidence about the memory industry with their new HBM4 technology, which was sort of uncharacteristic for Samsung executives to be that confident about the sector. And you can see a little bit of an upside in the stock today. But that confidence seems to be really broad-based, especially on all of this AI spending. TSMC's January sales growing at their fastest in months, a sign of sustained global AI spending, even as concerns persist about potentially an industry bubble. Our Asia equities reporter Winnie Su joins us for more. So what stood out to you from the TSMC results?
Yeah, Sherry, the TSMC results actually pretty strong. You're talking about January sales coming at 37% year over year, and that is higher than what TSMC is guiding for their revenue growth of 30% for the year. Well, obviously, there is a bit of a pull-in ahead of that Lunar New Year, so we are expecting maybe a bit more slowness when it comes to February results. However, Citi analysts basically is saying that they are expecting that TSMC can achieve the higher end of their growth target given the set of data that they've seen for January already. So lots of optimism there. And when it comes to stocks, yes, yesterday it was rising ahead of this data already, so up some 3.6%. Today we're still seeing reaching another fresh record, up another 1%. But worth noting that today is actually the last day of trading for Taiwanese stocks before Lunar New Year, and trading resumes on February the 23rd. So some of these expectations really rising ahead of that holiday that we will be headed into soon.
Winnie, we also got SMIC reports, the results, and that's sort of disappointed. It seems that memory shortage that we continue to see this year is having an impact.
Yes, absolutely. So far, remember this earnings season really unfold a lot of these winners and losers when it comes to this big memory crunch that we're talking about. Obviously, in Japan, we've also seen Nintendo and Sony getting hit by that. But SMIC is basically another example of that. We saw that earnings really missed estimates when it comes to net income and gross margin. And even for the first quarter expectation, they are right now saying gross margin may be coming about 18 to 20%, while general consensus is about 21%. So that also missed estimate. And they were talking about first quarter expecting net income and capex to remain quite flat. And that is really that pressure coming from how PC makers and smartphone makers having to cut their orders because of this memory crunch. So we're seeing further impact in the market right now spreading out.
And Winnie, before we let you go, I mean, we continue to talk about all of these new AI models from all of these different countries. And we understand that Alibaba has released one of their own as well. What are we seeing?
Yeah, that is quite an interesting and very exciting one. It's the new AI open sourced model that is aimed to help robots to complete some of these real life tasks. And that includes helping to map these objects, predict trajectories, and navigate some cluttered environment. So it is that part of the push for the government to support technology and robotics, including humanoid AIs. So we are humanoid robots. So we are seeing that really playing out, and how these Chinese internet companies expanding their AI capabilities to really touch onto these spaces. And speaking of Lunar New Year, we are seeing that red packet price war going on among these companies. You're talking about Alibaba, Tencent, and also ByteDance, for example, really giving out vouchers and subsidies for users to encourage them to use their AI apps. And that ranges from a series of services, from food delivery, buying tickets. So really, they're trying to capture more customers so that they can further invest in their AI capabilities.
Bloomberg's Asia Equities reporter Winnie Su there with a wrap of all of the AI and tech-related news that we have going. Of course, all of this mania around artificial intelligence also sending South Korean stocks on a tear. Retail investors increasingly fired up with active accounts and margin loans hitting record highs. Bloomberg opinion columnist Shuli says that's in contrast with the fatigue, perhaps, that we're seeing in U.S.-based AI trades. Shuli joins us now with the latest. So Korean retail investors, so-called ant investors, they're pretty powerful. How invested are they in this tech and AI mania?
They were very invested in the U.S. tech and the AI mania, but not so much with their own homegrown tech giants such as Samsung Electronics and SK Hynix. In the past, last year especially, they were chasing after U.S. tech stocks and a little bit of the small cap domestic Kosdaq index, but not so much the Kospi. But we're starting to see them coming into buying HK Hynix and Samsung Electronics in the last couple of weeks. What we're seeing is that not only are they opening local brokerage accounts, they are also putting a lot of money into those local brokerage accounts. So in a sense, if Koreans retail investors start to invest in Samsung and the Hynix, these two stocks have much further to run.
Is it because they're cheaper than their U.S. counterparts?
They are quite a bit cheaper. If we look at the estimated operating profit, Samsung and Hynix are the world's 6th and 8th largest non-financial companies. But if we are looking by the market cap, they are only the 16th and 25th. So going back to the Korean retail investors, if they somehow believe Samsung and Hynix can become the next generation, I don't know, NVIDIA or Broadcom, then these two stocks have a lot to run.
So how much firepower do Korean retail investors have?
So right now they're sitting on about 70 billion of cash deposits with their local brokerage accounts. And in the U.S., they have an estimated 170 billion U.S. dollars of U.S. stocks, which they can offload anytime and repatriate back to South Korea.
Especially given that this is not a rally just around the most advanced chips, it's also about memory shortages at the moment. How much more can we expect Samsung and SK Hynix to gain from here when we have already talked about tripling their stock price?
It's hard to say, but I think if you look at the South Korean retail investors' trading patterns, in January, for instance, they bought into Micron, U.S.-based Micron, and the Micron is competing with Samsung and Hynix. So, and the Micron is quite a bit of more expensive than the Korean names. So if, say, they start to swap out of Micron into the Korean stocks, we can talk about another maybe 10-20% rally?
When we're looking at the broader tech space and the broader market, Shuli, of course, there is concern right now that there's a lot of anxiety out there because of this AI build-out. And not to mention, of course, will it pay off and how much of this is being financed by circular deals? We have continued to see also these tech giants just really sell more debt. What is Alphabet? More than $30 billion in the last 24 hours or so. Are there any broader implications for market depth, for the dominance of these companies, even in the Korean Kospi, for example, Samsung and SK Hynix taking the bulk of that market?
That's a really good question. I think what we are seeing is that if you want to play this whole AI theme defensively, you need to look upstream, right? Go to the memory chip makers, go to TSMC, because at the end of the day, they're still making money. They are seeing record high operating profits, whereas the downstream makers, say the LLMs, the developers, they're not making very much money. So in a sense, if you invest in Asia's supply chain, you are actually taking a defensive position with the AI rally.
Oh, that is a very interesting point, Shuli. Are there any concerns, though, about the big investments? I know that in Asia, for example, private markets are not as big as, for example, in the U.S., but we have seen even private market players taking a hit last week on concerns about this AI build-out and how much they have invested. Is that a vulnerability that could potentially be an issue across Asia as well?
I think it could, but again, the private markets in Asia are much smaller because the banks are just so much more dominant. And I think if we're talking about the dominoes falling like the house of cards, right? Like Asia is not going to be the first ones.
That's a good point. Shuli Ran, good to have you with us. Bloomberg opinion columnist there with what to expect from the markets. Of course, we continue to see that intense focus on tech shares. Take a look at how markets are faring at the moment, because we have seen that sell-off when it came to the Philadelphia Semiconductor Index in the overnight session. So broad pressure around semiconductors, chip names, but at the same time, some turnaround for some names like Samsung, for example, on confidence about their HBM4 shipments, not to mention, of course, positive results coming from TSMC and the likes. But coming up, we'll be heading back live to Consensus Hong Kong. Robinhood Crypto's Johann Kerbrat joining us with a look at the company's big bet on prediction markets. Much more ahead. This is Bloomberg. Bitcoin continuing to move lower, below $69,000, roughly about 50% off its all-time high. Even the recent rebounds that we've seen has been pretty shallow and unstable. You can see at least Ether and Solana continuing to gain, but even Ether, of course, has dropped substantially, about 60% since its peak back in August. And Coinbase's Brian Armstrong, for example, no longer among the world's 500 richest people with the crypto crumble. Not to mention that brokerages like Robinhood also, their net income tumbling more than 30% because of the declines in Bitcoin and other cryptocurrencies. Let's get back to Consensus Hong Kong, where Annabelle is actually standing by with a senior executive of Robinhood. Belle.
Thanks, Sherry. Yeah, joining us now is Johann Kerbrat. He's Senior Vice President and General Manager of Robinhood Crypto. So, yeah, I mean, your role really speaks to, I guess that crypto side of the business. And as Sherry said, that was what played into the numbers overnight. What did you make of the crypto route and just the dent as well to Robinhood profit?
Well, I think for us what was really exciting was that it was a record quarter, also a record year. And so at our situation, we are looking at crypto for not just trading assets, but also as a technology that we can build on top of it. We launched our tokenized product, stock tokens, in the EU last year, where we offer exposure to US stocks and ETF. And our goal is to keep building on this idea of this technology.
Okay, but let's talk, though, about again, the declines that we've seen. I mean, what sort of pullback did you see in trading activity, and what did it look like in terms of the user base and where the flows were going and which assets, etc.?
Yeah, so actually it's interesting. Like, we see our customer taking advantage of the situation. We see a lot of buying the dip kind of situation where people are actually diversifying their portfolio either into crypto or different type of assets. But the beauty of the platform for Robinhood is also that they can go in multiple different asset classes. So, for example, prediction market, equities, options, all have had very good quarter as well. And so we see our customer being able to go between all these different businesses and financial instruments.
I think what's interesting in crypto at the moment as well is on the one hand, we've been talking this morning about these so-called whales, just perhaps that more of a handful of investors, very big, high net worth individuals that are coming in to perhaps prop up sentiment somewhat. But really across the institutional side, I mean, it's just been big outflows from the ETF. So what are you seeing there essentially in terms of trading activity, if you could just break it down again between the so-called whales, I guess, the institutional, the retail side as well?
Yeah, so we have two different platforms. We have Bitstamp, which is our exchange that we acquired 9 months ago. We still see institutions very active. Actually, we are here in Hong Kong and we are spending a lot of time with partners. They are telling us how well Bitstamp has been scaling and how much they can build on the platform. So that's been exciting. on the retail platform, we are seeing different customer segments. Until now, Robinhood was very much for the more simpler type of customers, and we've been building a lot of advanced tools and features to actually bring more of these high net worths or whales that are trading a lot. And now you can trade as low as 3 basis points in terms of fees, depending on your volume. And so that's something that has been really exciting for us, where we are able to attract this type of customer that we were not able to before.
No, go ahead.
No, and really the last thing that we see also is a lot of adoption from other products. Staking, for example, transfer is something that we are still seeing a lot of activity in.
You've also got into the underlying architecture space, or with a new layer 2 technology, but can you explain the details of that and the roadmap around it as well?
Yeah, absolutely. So we just announced the launch of our testnet for the Robinhood chain. The Robinhood chain is a layer 2 on top of the Ethereum network, and the goal is to really focus on bringing financial instruments into the chain. So we are a bit less focused on everything going on in crypto and more into bringing US stocks, equities, and more into the chain. At this point, we are just at the beginning, so we are really inviting developers to come build. We are focusing on decentralized exchanges, lending protocol, and these kind of things. We already have partners with Chainlink, Layer 0, Alchemy, and more. And we are also going to announce a hackathon with $1 million in prize. So the goal is really to bring people over onto the chain.
And what does that look like over the longer term? What's the overall goal here with that?
Yeah, I mean, we think really the blockchain technology can replace a lot of the financial system. So on our goal, we are really looking at offering 24/7 and instant settlement for US equities and stock tokens. And so we think that slowly by replacing the pipes that have been running the old infrastructure, we'll be able to bring this advantage to the customers, reduce the cost, and give them more features that are more advanced than what they get today.
One of the advantages, I guess, of downturns in any market is that if you're looking to grow by acquisition, it's a good moment for you, because valuations for businesses, of course, are well off the highs that we've seen in recent years. And you've just made 2 acquisitions in Indonesia. How important is that market to you?
Yeah, we think the Asian market overall is very important. We think Indonesia is actually ripe for changing. For example, there is 13 million customers that are already trading crypto. And so we think it's a great timing for us to get into the space. We also have an acquisition of Bitstamp, like I mentioned 9 months ago. They have a license in Singapore, and so we've also been able to start bringing institutions, hedge funds, family offices onto the platform. And so it's really about slowly getting into the market, and we really think that there's a lot of understanding about crypto here. A lot of customers are looking at it for ways to maybe hedge against their local currencies, or for a way to get exposure to other type of assets. And so we think that between digital assets and the asset that we are tokenizing, people will have a lot more access than they used to have.
Where would be the priority markets then in Asia for you?
No priority at this point. I mean, Singapore is definitely our headquarters currently, because we already have a team running there. But we think that slowly we'll be able to expand across the region.
Then just in terms of overall outlook for revenue and profit, for Robinhood Crypto specifically, what would you see as being the contribution of Asia this year or even into the future? What's your sort of goal around that? Yeah,
we don't necessarily have a direct percentage, but I think for a long time international was a bit of a seed that Robinhood was starting to plant, and now between our business in the UK, our business in the EU, Asia, and also we have announced an acquisition in Canada, it's going to become more and more meaningful for Robinhood. At this point, we already have 750,000 customers outside of the US, and we're going to see this number grow with the time.
Okay, so that's sort of the outlook, I guess, for the crypto side of the business. What about what was a very big news overnight, which was we saw this huge sell-off in wealth management stocks. This has been an interesting sort of theme we've seen across a lot of different industries. I mean, we've seen, of course, the software stocks being hit, the insurers being hit. Wealth management sort of seems the latest. Do you see that sort of threat, I guess, from AI as a disruptive force to your industry as well?
No, we actually see AI as a strength for us. Robinhood has been able to adapt to AI very quickly. initially we started to use it for our employees, for software engineer, for anyone really at the company. Our leadership has been pushing everyone to adopt AI. And so now a lot of our code is actually produced by AI. A lot of our work in general is produced by AI and allows us to actually focus on the big and complex problems. And the other side that we focused on was to actually bring AI to our customers. And so, for example, we have this product called Cortex that is available for Robinhood Gold customer, giving a lot of information about what is going on in the market, why is the stocks moving, and really bringing the same type of information that you will get if you were sophisticated traders or working at a hedge fund with a Bloomberg terminal, but right into the palm of their hand. And so, I think for us, that's going to be our focus. We also did a demo last year where we showed that we could really build a system that will create indicators, will create strategies for you using AI. And we think it's going to be a very important tool to level the playing field and bring everyone into the same way to be able to trade assets.
And what's been the sort of uptake, I guess, on that? Because that was, that sort of like personalized approach. We saw it with tax strategies overnight, but what's been the uptake that you've seen so far from customers?
Yeah, our customer loves the AI tools. I think we're seeing more and more adoption of it. And it makes sense, there's so many assets, there's so many things going in the world that's all time of the day. Until now, it was very difficult for customers to be able to just follow what's going on. And so instead of having to constantly jump between platforms, going on X or on the news to understand why is the stock moving, now they get everything within the same app.
You're making me a little nervous around the outlook for media there, to be honest. But I do want to ask as well, just a bigger picture question around crypto market activity. What do you think what's your outlook essentially on prices to this year and the sort of dynamics that we see as well? I think, as I said, it has been a period where you've sort of been marked by lower levels of enthusiasm, I would say, even on social media, but from, as I said, that lack of demand from the ETF side. What is your outlook for this year?
Yeah, we think, there's always a cycle happening in crypto, and I think it really depends also of what utility we are bringing on the systems. I think, at Robinhood, we focus a lot more on building tools and building utility on top of the blockchain. And I think that when you will start seeing more and more people using it, the enthusiasm will come back. But at the end of the day, if you compare today to a few years ago, we didn't have institution coming in, we didn't have ETF, we didn't have big platform using stablecoins. So, it's a very different time. And I think at some point it's good also to have some correction to make sure that we have a strong structure to build on top.
All right, Johann, thanks very much for your time and good to see you again. That was Johann Kerbrat there of Robinhood Crypto. Sherry, I'll pass it back to you.
Yeah. Thanks for that conversation. Annabelle Jewelers there in Consensus Hong Kong. Take a look at what's moving in the Indian markets. We're seeing that extension of gains for a fourth consecutive session at a time when we're also seeing the White House revising their fact sheet on the India-U.S. trade framework, removing a clause that New Delhi would reduce tariffs on certain pulses. The U.S. had earlier said India agreed to ease or scrap tariffs on pulses in the list of agricultural products. We'll be discussing that in the next hour, but still ahead, Indian fashion and jewelry giant Titan joining us for an exclusive interview about how the gold rally is impacting their business outlook. And also we'll be back live at Consensus Hong Kong to get the outlook for blockchain technology with Solana Foundation. Welcome back. You're watching Insight. Take a look at how Asian trading is getting underway because we're seeing broad risk-on sentiment with materials leading some of those gains. Commodities are gaining ground and rebounding from some volatile days before. We are seeing also the tech sector, which has been pretty fragile, now rebounding in the Asian session, despite the fact that we did have the Philadelphia Semiconductor Index down more than 4% in the overnight session. So Nifty stocks are up now for a fourth consecutive session. Japan is away on holidays, but the Kospi is also gaining more than 1%. We have seen that fragile sentiment, though, really expand over the tech sector in recent days. We had the software makers sell off. We had brokerages selling off, credit firms selling off. And at this time, it seems it has spread to wealth managers as well and concerns about AI disruption. So the hot new trade potentially dumping any stock seen as vulnerable to AI disruption. Shares of Schwab, Raymond James, LPL Financial falling 7% or more after startup Altruist unveiled a tax strategy tool called Hazel. Some say the fears are overblown. Software names, we saw them rebound a little bit from last week's sell-off, but analysts warning that the reaction just shows how jumpy markets are after a long AI-driven run. For more, we're joined by Bloomberg tech co-anchor Annabelle Drewlers live from Consensus Hong Kong, where, of course, we're focusing on crypto, Web3, AI. So a pretty timely event, Annabelle, where you're at right now. How is the industry reading these AI disruption worries?
Yeah, well, it's been a move that really seems to have caught a lot of investors by surprise because, as you just mentioned, some of the selling that we saw there for names like Charles Schwab, for instance. Charles Schwab was the only stock that had a sell rating. But as you said, it's this new tool that came out overnight. It's by a company that's very closely held, tech startup as well, called Altruist. And this new tool that they've unveiled essentially helps advisors or financial advisors personalize strategies for clients and create documents. So there's a big concern here around what does that mean for the wealth management industry in particular, and is their traditional business model, are their traditional revenue streams at risk? And that's why you saw such big selling activity. Is there a risk that this is overblown? Yes, possibly. As I said, Charles Schwab is the only stock with a sell rating, so some of the investors we've spoken to say that dip buying could be possible when we get the reopen for the next day's trading. But still, at the same time, I think it just speaks to that broader theme that we're seeing in markets here, where investors essentially seem to be going from sector to sector. We've seen software stocks, for instance, we've seen the insurance stocks being hit, and just really questioning how insulated their overall dynamics are against, of course, the rise of AI.
Especially when you're thinking about how circular some of this funding could be. And we have seen, of course, the really immense amounts of money being raised by all of these hyperscalers. What, Alphabet, more than $30 billion of debt in the last 24 hours or so.
Yeah, it's really incredible numbers. And I think that, to your point, I mean, what stood out just in terms of the latest round of big tech earnings in the US was these really extensive capex plans and companies like Alphabet saying that they're going to be outlaying $185 billion this year. I mean, that's more than the last 3 years combined. So it is a very intense spending plan, and that's why they're going into these debt markets. It's probably a good moment to enter these debt markets as well. Valuations are looking very rich. But yes, they've raised almost $32 billion in the last 24 hours. So it's $20 billion in US dollar denominated debt. But they also tapped the sterling markets and the Swiss franc markets. The sterling market, I think, is one that's very interesting. Swiss franc has been more of a diversification strategy for some businesses, but the sterling one in particular, because as part of that issuance, they actually issued a 100-year bond. A 100-year bond, I mean, we have not seen that going back to Motorola in 1997. So you're very much in the dot-com era at that point. And just that level of demand that we're seeing as well from investors, it tells you that I guess a lot of fears that we'd seen out of the big tech earnings, yes, around capex, but around that investor demand, would actually the finance be available, seems to have been answered somewhat for now.
What's interesting is that despite the anxiety, we are seeing some of those rebounds for names like Oracle or some of the software makers that really saw the sell-off last week, right? So sentiment might be fragile, but it seems that we are seeing a little bit of upside in certain corners of the market. What's happening to crypto, though? I mean, the crypto space just seems to be in this prolonged downtrend since last year.
Yeah, I mean, I think if you talk about sentiment being fragile, it's a lot more fragile over here in the crypto space. It's one of course, the key talking points. This event here, Consensus, is one that's very much aimed at the institutional investors, and institutional investors as a whole have been a little bit more sanguine on the crypto sector. We've seen significant outflows from ETFs, for instance, and sort of a lot of investors choosing to stay on the sidelines. Yes, we've had that big sell-off in Bitcoin, and you're around 45% off the record highs we saw last year with $125,000 per token. But what's interesting is even though you've seen a recovery from that mere 60,000 mark we hit last week, to 70,000 or thereabouts this morning. It's actually being dominated, what we're understanding, from some so-called whales in the market. So these big wallets that have north of 1,000 tokens in them have added a few $1 billion, around $4 billion just over the past few days. And that is just a big question here is, again, that fragile sentiment and how many players are actually involved. As I said, many are still choosing to stay on the sidelines. But it is a good moment for this conference, of course, because we've got a great interview coming up with Lily Liu. She's from the Solana Foundation, but essentially going through some of these different dynamics that we've got in the industry.
Yeah, and you already talked to Robinhood, which was one company that is seeing the fallout from the crypto crash right now.
Yeah, that's an interesting one as well, because actually when you took a look at Robinhood's numbers, it very much was that crypto crash that played into the dynamics. I mean, we spoke with Johann Kerbrat. He's at the head of Robinhood's crypto efforts, and I mean, like you hear from a lot of different people at conferences like this, they continue to be bullish on the sector and to say that this is all just short-term headwinds that it's facing as well. But yes, it did play into the numbers, and the company though is continuing to pushing ahead with a new blockchain technology, for instance. They're exploring using that to bring more different real-world assets on chain. So that was one of the key parts of the conversation, but also continuing to try and bring in bigger institutional investors to the platform, and as well to continue their expansion into new parts of Asia, because they've made two different acquisitions of platforms in Indonesia of late, and of course their headquarters in Singapore, so looking for more opportunities in Asia.
Bloomberg Tech co-anchor Annabelle Drewler's there joining us from Consensus Hong Kong. And of course, she'll be back with more conversations from the event. But this, as we continue to watch the broader markets, we are seeing a little bit of a risk on day today. Japan away on holidays. Let's discuss everything that's happening, especially around the tech sector and that fragile sentiment that we continue to talk about with Bloomberg Life strategist Mark Cranfield. Mark, great to have you with us. I mean, we have seen a sort of sentiment sour around the tech names, or at least become more anxious about when this will start to pay off, or if too many players are vulnerable at this point. We don't necessarily seem to be seeing the follow-through here in the Asian session. What are you keeping a focus on?
It seems as though we're getting a little bit of the renewal of the rotation that Annabelle was speaking about earlier. So you do have the core players in the hardware space who are having a pretty good time of it. They still seem to be gathering plenty of funds coming into them, whereas the software makers are the ones that are really getting hit hard. And it's not too surprising when you consider that Taiwan Semiconductor just this week have announced, again, stellar revenue numbers. We see the Taiwan stock index at very high levels, having another great day today. They're about to go into a long holiday, and people are upgrading the outlook. Bank of America says that growth in Taiwan is going to exceed their original expectations, and the outlook for the major companies there is still very strong. Flows are coming in, the strongest net inflows for a couple of years from foreign investors. So clearly, people love the story coming out of Taiwan, which is primarily about the hardware space. That's where money is mostly going into. And on the flip side, we're already seeing people who are pure software developers in AI already getting in trouble. Now you've got it extending even to wealth managers as well, because clearly the risk here is that if a human being is doing a kind of a plain vanilla type of role in the advisory space, and you get an AI product which can come in and do it just as well, and presumably quite a bit cheaper, that's a real threat to their industry. Again, as Annabelle was saying, it may have got overdone, but traders will be looking at this carefully and saying, okay, there's winners, there's losers, and what they've been doing in the past few weeks is really emphasizing that winners continue to win and outperform, and the losers just get thrown in the trash bin and they never get a chance to come back. So you're getting that huge disconnect going on in the markets, and that's even before we start to talk about the amount of debt which is being raised by some of these major companies.
Does that concern you, the amount of debt? I mean, we mentioned Alphabet, for example, raising, $32 billion in debt in just 24 hours, but Morgan Stanley putting the number at potentially borrowing of $400 billion just by hyperscalers this year. Does the dominance of these players in the debt market, especially in the IG space, what are the implications of that?
Well, the big risk here is the one that's deep in the background, and that's the tail risk associated with derivatives attached to the bond market. So it's all very well that you get Oracle issued a big bond amount, Alphabet's doing even more, and as you said earlier, with a 100-year issue as well. All the companies are building up enormous amounts of debt, which is fine as long as the returns are good, they've got somewhere to invest it, everything looks safe. The big risk, as we saw briefly in December, is that if hedge funds, especially aggressive traders, if they get anxious about what they're seeing in terms of the risk profile in credit from these companies, they could jump on the credit derivative market, which is much smaller but much more volatile than the equity market. It takes a lot less money to move around the positioning in the derivative market. You can very quickly establish a negative feedback which goes back into the corporate bonds and then through to the equity market as well. Oracle shares suffered, they've rebounded since. But this is the outstanding problem. All of these big tech companies have issued debt in that space. Some of the Asian companies have as well. They may well do. Once this earnings season is out of the way, we may see the Chinese tech companies come back and issue debt themselves, because everybody has very big spending plans. But the more debt that you have out there, the more bonds out in the market, the greater the risk that somebody will attach your bonds to your credit derivatives, and that will feed back into the equity market.
And let's not forget the Hang Seng Tech exuberance that we've seen recently in the Chinese space as well, right? Leading to more valuation gaps and perhaps some worries about the earnings estimates from the likes of Alibaba, Baidu. But Mark, also I wonder, when we're looking at the broader equity markets globally, this concentration on tech and the rally and, of course, the anxiety around it, a lot of it was justified by the fact that no matter what, we still have a solid U.S. economy. We're ahead of jobs numbers now this week, and we're seeing more indications that perhaps the labor market might not be doing that well. Retail sales not great, delinquencies rising. How big of an issue could this be?
You're right. I mean, we're seeing a very mixed picture. Just yesterday, retail sales numbers were much weaker than expected. We've got the jobs numbers coming up, which haven't been very good lately, particularly the private sector numbers have been very weak, apparently the worst January since the global financial crisis. So clearly there are deep concerns that below the surface, the American economy is not performing as strongly as some people would hope. That's why traders are now considering we might need 3 interest rate cuts this year rather than 2, which was the case just a few days ago. Federal Reserve officials are trying to give a balanced view on all of this, but clearly the pressure is going to build up. If we get more weak data, the Fed will be pushed into a corner where they have to consider further cuts. The question here for investors is, will those interest rate cuts be seen as a positive, more liquidity in the market to generally boost the sentiment? Or is it a recognition that really the American economy is not in very good health and things could get worse from here? It's a very fine line between interest rates coming down, which is good, and interest rates which are seen as a poor factor for the market. We haven't quite reached the inflection point. But all we need is a few more poor pieces of data. If that feeds into GDP, if that comes in below expectations, we could easily get back into a scenario where investors see bad data as just bad news for equities.
Yeah, when right now, at least, bad data means that you're going to get a Fed put. But if you get rate cuts because the economy is not doing well, then you're going to spook the markets, right? When we're already seeing the downside pressure on the dollar, right? And we have been talking about the debasement trade. We've been talking about potentially, with geopolitical tensions adding to the lack of appeal, perhaps, of American assets. Japan is away on holidays today, but the yen continuing to see some strength. Is that just a greenback play because we're seeing broader dollar weakness? And what can we expect at the open? Because it's been surprising to me that after the election, the yen has been this resilient.
You have two sides of the story here. So initially, people were starting to sell US dollars because there were negatives on the American side. There weren't that many positives on the other side of the equation, but that is changing, and changing quite significantly. So we're beginning to see some clear choices by investors. Australian dollar is very much in favor. The Chinese yuan is certainly in favor as well. And we're beginning to see a change in sentiment towards the Japanese yen, which, don't forget, is the second most important currency from foreign exchange traders' point of view after the euro. So if you have an alternative, if the alternatives are looking much better, the reason for people to shift away from the US dollar becomes a lot clearer. What's happening with the yen is that going into the elections, people were very short. There was a lot of positioning, but you need incremental bad news to keep you going in that direction. That has not been happening. Very sensibly, the Japanese authorities, immediately after the election, they came out giving supportive words for the currency, much clearer signals than they were giving before. The interest rate odds in the market are now suggesting that we could have an interest rate hike in April, which is earlier than expected by the Bank of Japan. That's a positive for the yen. And the people are going back to look at some of the fundamentals, which have been changing in favor of the yen for some time. Interest rate spreads have been narrowing, very much in favor of the yen, and they still have a current account surplus, which a lot of countries don't. So the positives are building up for the yen. Positives are building up for the yuan. PBOC is firmly behind the strong currency. And now we've had a rate hike in Australia. And judging by the comments today from the RBA, there could be another one to come. Aussie dollar is also attracting a lot of new money as well.
Yeah, we're talking about 3-year highs or so. Mark Cranfield, always a pleasure speaking to you. Thank you so much. Bloomberg M-Life strategist there. As we continue to really digest the market moves, we're watching Indian stocks gaining for a fourth session. Still ahead, the White House quietly revising its fact sheet on the India trade deal, removing a reference to a key agricultural product. An update from New Delhi next. This is Bloomberg. The White House has quietly revised its fact sheet on the U.S.-India trade agreement, removing a reference to a range of agricultural products and changing language around digital services. Let's go to New Delhi and bring in our economy and trade reporter Shuli Srivastava. Shuli, so we're talking specifically when it comes to farm goods about certain pulses which are politically sensitive in India. Explain to us why this is significant.
So, after months of negotiations, India and the U.S. finally managed to, agree to a deal. And the U.S. agreed to eliminate tariffs on India to 18%. But the confusion around the deal and the details of the deal, they remain. They agreed last week on a joint statement. They had put it out late last week. And the White House came up with a fact sheet on India trade agreement. But as you said, the fact sheet has been quietly revised. References to certain pulses and, some additional products which were not part of the joint statement that was released last week, they found their way into the fact sheet. The other thing that Indian officials were at pains in here to clarify that India has committed to an investment of $500 billion. It was just an intention and not a commitment from the Indian side. That's what the officials in New Delhi maintained. However, the fact sheet laid down clearly that India has agreed to eliminate or phase out duties on a host of farm products, including pulses, and India has committed to buy goods worth $500 billion, including agricultural products. India has agreed to remove digital taxes and negotiate for a broader digital tax trade rules. Now, some of these claims which were made in the fact sheet earlier, all of these references have been dropped from the revised fact sheet which was put out on the website of the White House, and that has clearly sparked more confusion and concerns. So as such, reference to farm goods in the deal had anyway sparked concerns among opposition parties in India and farmers, some of which are, they have vowed to protest. So the lack of clarity has actually created more confusion around the deal on what has been agreed upon.
Especially to your point about India changing or the U.S. changing the language of India committing to buying more American products instead of just reflecting an intention. Given how important farmers are for the Indian economy and also for the political, as a political voting bloc, tell us how consequential these very quiet changes could be.
these quiet changes actually could be quite consequential, given the fact that some of the farmers groups in India, they are planning to protest and strike later this week. So this dropping of reference to pulses, it will give some sort of comfort to the Indian government when it tries to negotiate with farmers and convince them and allay their fears. So this is definitely going to help the government in that sense.
Bloomberg Economy Trade and Investigating Agencies reporter Shuli Srivastava there with the latest on the U.S.-India deal. Let's turn to China because we also got price data from the country showing a mixed picture for January. The consumer price index cooling, factory deflation easing more than expected. Let's bring in our China correspondent, Min Lo. So what stood out to you?
Hey, Sherry. Yes, certainly the pullback in the CPI numbers is quite disappointing, right? Missing estimates coming in at 0.2%. It was a big pullback from the previous month of 0.8%. A part of this is because of base effect, because we have the seasonal factor here. Lunar New Year was in January last year, but this year is going to be in February, so we don't get that sort of holiday-related boost to the CPI this time. The PPI declining by 1.4% is an improvement from the previous month, but I've been speaking to economists, right, and a lot of them are attributing this to the gains in material prices, especially commodity prices like copper, which has tripled or quadrupled in the last few months. So doesn't necessarily reflect a stronger underlying demand. And in fact, the higher material prices could eat into profit margins for businesses as well. So overall, it's not a very positive picture for the price data in China.
Min, does this mean that we could see authorities acting, especially with more stimulus measures?
Yeah, so this is something that's quite hard to say at the moment, because if you look at the growth target that some of these provinces in China have set, they are generally setting them more conservatively this year. So it looks like China is also not going to lean too hard to overstimulate the economy to achieve very strong growth. They might take a pragmatic stance here. We have seen when it comes to fiscal stimulus, for example, the government pulling back just a little bit when it comes to the consumption subsidies. They are extending some of the interest subsidies, but still, analysts are saying that a lot more needs to be done, especially when it comes to supporting the income of the people who are poorer or the middle class people. And there seems to be a bit of a phenomenon of old habits dying hard, right? Because China has been so used to supply side sort of stimulus, and it seems like this is going to take many years for China to really address some of the underlying structural issues.
Right. Min Lo, good to have you with us, Bloomberg China correspondent with the latest eco numbers out of the country. Still ahead, we'll be speaking to an Indian fashion and jewelry company. Welcome back. You're watching Insight. Take a look at how precious metals are trading at the moment. We continue to see gold above that $5,000 an ounce level. This, of course, after a lot of volatility, especially that given that just about a week ago we had seen it really experiencing the worst plunge in more than a decade, since 2013 or so. So we continue to see the volatility when it comes to precious metals. Silver also gaining about 2% at the moment. It's nearly doubled this past year. We continue to see this historic supply squeeze, surging demand from India as well. And of course, expectations of where the US dollar is headed, given that we had some weak economic numbers with retail sales in the US unexpectedly stalling, supporting the case that perhaps we might see deeper rate cuts from the Federal Reserve this year, and that really all being felt across the metal space. Shares of Evolution Mining today gaining ground in the Sydney session after the gold and copper miner said it will use record profits to push ahead with two major high-grade expansion plans. First half underlying profit also jumping 104% on year. CEO Laurie Conway told us exclusively he sees further upside for gold prices.
In gold, when you look at it, there's a structural shift, and we've talked about this previously, that everything that's going on geopolitically, central banks are continuing to buy gold. We've seen it around the $5,000 an ounce. There's talk that it'll go to $6,000 an ounce US in the next few months, on the back of continued buying on concerns around the US economy. And so, for us, we do see that there's more upward in the price than there is on the downside at the moment.
Is that how, Laurie, you're going to finance some of these expansion plans that you've outlined? Walk us through them and how you're going to fund these projects.
Yeah, look, I mean, for us, the balance sheet has always been set up to be able to fund all of our organic growth. And so, our gearing went from 33% to 6%. We've got just under $1 billion of cash in the bank. We made $608 million in free cash flow in the last half. And that is at a price that was about, $1,500 an ounce below spot. So the cash flow going forward is going to be more than it was in the first half of the year. We can afford to invest in those projects. And when you think about it, the $608 million of cash that we generated in the first half was after we had invested in the business. So we will be funding it out of our own balance sheet. It's a really strong balance sheet that we've got that can really afford to invest in these projects. And as I said on our call today, it's the right time to be investing in these projects because they're going to generate materially higher returns than what the portfolio is already delivering.
You also have a little bit of copper when it comes to your portfolio. Do you plan to expand your production there? How does it compare to what you have going on with gold?
Yeah, so in the first half, we're around 25-30% of our revenues coming from copper. The two projects that we've announced today at North Parkes and Ernest Henry, they are copper gold mines, and so we're going to be expanding production at both of those, which will then lift our copper exposure. We believe that it's good to have copper in the portfolio. We think we can have up to 40% of copper in our portfolio because when you look at the supply demand between now and 2030, the supply is not going to match demand for copper. So that's going to be good from a copper pricing perspective. And for us, doing it in our existing operations at North Parkes and Ernest Henry, we can bring that copper on in the next few years at a relatively low capital intensity and certainly a lot higher rate of return. So we believe that the outlook for copper is good and having copper in the portfolio is a differentiator for us.
You touched on this earlier when it comes to your bread and butter gold, in the sense that we are seeing structural shifts underway in the market. With the weakness in the US dollar, is that something that you expect to continue, and how do you see that playing out in the precious metal?
Yeah, I do think that when you look at what's going on in the US, their rising debt, it's gone up by a couple of $1 trillion in the last 6 to 7 months. The interest bill is rising. It's going to put pressure on the US economy. It's going to put pressure on the strength of the US dollar. Therefore, that bodes well for gold, and that's why we see that gold price has got more upside than downside, and it is linked to the economy, not just the central bank buying.
Evolution Mining CEO Laurie Conway speaking to us exclusively on Bloomberg. Indian jewelry and fashion accessories giant Titan has reported net income for the third quarter that missed the average analyst estimate. Still, the Tata Group company says its jewelry business recorded near record quarterly growth during India's peak festival and wedding season. Joining us exclusively now is Titan company CFO Ashok Santalia. Ashok, thank you so much for joining us today. We've just heard from the CEO of Evolution Mining how they've really profited from the surge in gold prices. We have seen gold, silver, precious metals just soaring and seeing a lot of volatility. How has that impacted your business?
Thank you, Sari, for having me on your show. Titan always maintain a predominant hedge position on the gold price. So we believe that we don't make money from the commodity price movement, rather by converting that into exciting jewelry pieces and through our making charges. That's the model which we follow. So, but the point is that accelerated rising prices do have sometimes impact on consumer sentiment, or sometimes they put pressure on our margin profile because diamond jewelry have a gold content which go up in value, and that puts pressure on the margin. But we have various levers which we have been working on, like introducing low caratage gold jewelry, modern jewelry, diamond jewelry, and designs, trying to offset that margin pressure. But at the same time, the growth which is coming by is more ticket-led at this point of time. Buyer growth is also muted. And we personally would like it to be balanced, that we get some ticket price growth as well as buyer growth.
You're also coming off a peak festival, wedding season in India. How has that played into your results?
We just concluded Q3, and I think we have been very satisfying. 40 to 42% on a consolidated basis, 40% jewelry business in India has grown, which is very, very satisfying. And through operating leverage, margins have also played out very well. So it's working out very well. We are expecting if prices do stabilize a little bit with marginal uptick, that's the best environment. But it looks like in your previous show, your CEO of Evolution Mining was talking that gold seems to be in uptrend for foreseeable future.
Does that mean that you continue to adjust prices upwards to reflect that?
We adjust our jewelry prices on every day basis, so it completely reflects, and that's how in India gold jewelries are priced, because we are transparent with consumers. What's the gold price, metal price, what's the making charges, etc. And in India, if you would know that a lot of investment angle is associated with gold jewelry purchase. So it's not only adornment, it comes with the investment wrapper also. So a complete transparency on what they are getting is available to consumer in India. So prices change almost every day basis.
What about that? Makes sense. What about the supply side of things? Are you seeing any tightness in the markets, and how do you really mitigate inventory risk?
We kind of encourage a lot of gold exchange program, and they really help when the prices are rising like this, because then customer decision, the pricing gets out of the equation of customer decision making. So exchange program is promoted in a big way by Titan, not only our jewelry, but as well as jewelries purchased from other jewelers. As far as gold supply is concerned, we are not experiencing any tightness. We have in India, most of the gold get imported other than what we exchange. And there are agencies, authorized agencies, banks, financial institutions, which help us, and Titan enjoy very, very good line of credit lines with these banks. So supply side is not an issue for us.
The volatility that we just talked about, how do you hedge that, given that although prices are rising, we have also seen that incredible fall just about a week ago, the worst plunge in over a decade in pricing?
No, so we are completely hedged. So there are 2-3 methods, which we employ. One is there is an instrument, working capital instrument, which is called gold metal loan or gold on lease. There, the pricing risk stays with the institution which supplies us. And when we sell the jewelry at that day, we freeze the price. So the price risk is not at all there. And 50% of our gold sourcing happens through that. And remaining 40-50% to kind of be hedged in various exchanges, MCX and Gift City, there are international exchanges operating. So we completely go. So we don't take position predominantly hedged, I would say. Sometimes 2-3-4% or single digit position can be there, but that's very well calibrated.
In this environment where we continue to see the volatility and the uncertainty in precious metals, how do you position your business, especially if you're thinking about growth?
The best environment for us is that calibrated up move for gold prices, where the one is that customer then don't defer their purchase, they don't try to time their purchase, rather prepone their purchase. And the whole thesis that gold is a good hedge against inflation holds true in the minds of customer. So that's the best environment for us. Volatility, which kinds of create a problem for us, then customer tries to time the market. Last 18-20 months have been very, very accelerated uprise in the gold prices, and that is where most of the growth is coming through the invoice value increase, the ticket size increase, the buyer increase is becoming muted. But in the given environment, I can tell you the growth is coming because of the either ticket size or whenever there is some correction, buyers are coming in, which is we saw in January when some corrections happen. The people who have been waiting, I think they came out and they kind of made their purchases. So it's a combination. If prices are going up, we get our growth through the price, ticket price. When it slightly corrects, then we get a combination of both. So we are not worried that much about strong double-digit growth coming by for foreseeable future for us.
Ashok, what about the state of the Indian economy? How much does that really change the behavior of your consumers, and what do you expect for 2026?
Indian economy, I think, growing well. The macros are also in place, and government has been providing necessary stimulus in terms of income tax rebates to consumers, GST rationalization, etc. So that way, Indian economy is behaving well, and gradually, what we believe that as per capita incomes are also gradually rising, premiumization is a trend which is playing out in India across categories, not only jewelry, but we have like watch business and eyewear business and other categories like fragrances and bags and saris. Across categories, we see the premiumization is a trend which is accelerating, and we are also kind of aligning to some of those things. While it's important to maintain our offering at various price points, but premiumization, I can say, is a big trend in India right now.
So given all of the different products that you have, how exposed are you to, say, the likes of trade deals with the United States, where we're trying to get a little bit more clarity on what was entailed there? Not to mention that, of course, India has also achieved a trade deal with the EU after 20 years of negotiations.
Yeah, no, I think in a way that got fast-tracked because of whatever was happening with US, but now US has also got, in a way, resolved, I would say. We are still 95-96% India-centric company. 4% of our revenue is international, but it is growing at a very, very fast rate, and our endeavor is to keep growing our international revenue. We just concluded the mass acquisition, and that will start flowing in our books from 1st January. So that's a very, very decisive move to go beyond Indian diaspora. Our international moves also were so far centered around Indian diaspora, but now with Damas, we are kind of getting into Arab segment as well. US, with getting sorted out on tariff and some of the supply chain solution which emerged during the tariff crisis, I think both are putting us back in the game of expansion in the US market. We are also looking at Canada favorably to set up some of the Tanishq stores. So international play will remain calibrated, but will keep growing much faster than what's happening in India.
Have you seen a lot of the issues that you mentioned around the supply chain side of things because of tariffs now becoming resolved? And what are the bright spots for 2026 when it comes to Titan?
I would say, in jewelry, now the expansion of international in GCC was in any way, GCC countries was continuing. And with Damas coming to our fold, we have a much sizable presence, and we have much bigger plan for that region to kind of address not only Southeast Asian communities, but as well as local Arab communities. So that's a big piece of, development which will unfold in 26 and 27. On the other side, Western world, US, we will further grow, and Canada, we will open up. So that's the other piece. Coming back to India, still remains the largest and most happening in the sense that we still have a lot of opportunity. Our market share opportunity is huge. We are still in jewelry, India market, 8% market share. So there is a leg room or headroom for us to kind of keep growing. And if our other categories like watches, etc., are doing extremely well. So overall, all in all, and if you look at portfolio, Carrot Lane, Mia, Zoya, Tanesk, and now Damas. With these 5 jewelry brands, we are in a position to address widest choices for the customer at widest price ranges. So we are well equipped to
Ashok Santalia.
Yeah.
It's really good to have you with us, and thank you so much for that conversation. We'll have to leave it there, but he's the CFO at Titan Company. We need to go back to Consensus Hong Kong because Annabelle Jewelers is there standing by with another big guest. Annabelle.
Thanks, Sherry. Yeah, joining us now is Lily Liu. She's president at Solana Foundation. Great to have you with us this morning, and obviously a really interesting moment. We were just discussing or reflecting on, yes, some of the trading activity, also what you're doing at Solana Foundation. But let's just get started, I guess, with the moves that we've seen, because especially for coins that are Bitcoin, of course, is the biggest in the market, but for coins that are further down that list, they've seen a lot of sustained selling pressure and haven't really recovered to the same extent either.
Absolutely. I think a lot of people are trying to understand why we had this huge sell-off 9 days down in the past. There was a very clear trigger for it. There was a very known institution that went upside down on their balance sheet, and it was known, right, which hedge fund blew up, which exchange blew up, which lending platform blew up. But this time, there was no public trigger like that. And so where did the $6 billion sell wall on an exchange come? Because typically that's not how people liquidate their holdings or monetize their holdings. So I think people are still trying to understand where that came from. But there's not much you can do when you have that amount of selling pressure that shows up all of a sudden. And it's not really just crypto either. I mean, what you have also at the same time is you had a huge sell-off on software due to concerns around AI productivity, limiting the growth of SaaS in the future. So first you had the Fed chair, then you had silver, which itself is like a fairly momentum-driven trade, and compounded with the JPY carry trade earlier this year, and then on top of that, software and tech generally. So this is not really specific to cryptocurrency and Bitcoin. I think there's been just an overall macro correction, and things are always amplified in crypto.
It's interesting because I think, to your point, I mean, we have tracked the correlation of crypto to a number of different asset classes, but now you're sort of, I think a lot of people outside specifically of the industry are really struggling to understand what is the asset class that crypto is most correlated to. And did you get any sense of where that sell-off originated, or which region perhaps was driving it?
You know, people are speculating, and we'll find out more as time goes on. But I think it is an indication of how widespread adoption of cryptocurrency is through the various direct, whether it's direct holding or through ETF holdings. In the last cycles, it would have been very obvious what happened, and the fact that this time it was not very obvious what happened is, early indications are it likely originated from sort of more recent institutional entrants into the space.
What do you think about the narrative as well? Because we've obviously seen Bitcoin for a long time being called a digital gold, for instance, sure. and you've recently been on X in a post that's picked up quite a lot of interest, but talking around how blockchain should essentially prioritize the financial narrative. What did you mean by that exactly? And does that mean that you're deprioritizing things like Web3 or DeepIn, for instance?
So I think that blockchain does two things. It's only ever two things. There's the asset side and there's the infrastructure side. Bitcoin is the asset, Solana is the infrastructure. Infrastructure for what? It's financial infrastructure for the internet. And I think all of the use cases that blockchain has ever explored actually fundamentally come down to a financialization of something. And so a few years ago, what a lot of people sort of thought about as being a consumer trend in blockchain, actually it was about the financialization of JPEGs and new consumer experiences fundamentally were financial in nature. And so I think that the narrative around Web3 sort of expanding read, write into own, I think it's not incorrect. I just think it's incomplete. Because seeing this as sort of an extension of the consumer internet and an extension of sort of applications that now have tokens in them is one side of the story, but fundamentally, what is the innovation? The innovation is being able to create markets on the internet around practically any asset, which is not to say that every market around every asset is going to be equally interesting, equal in risk, duration, or anything like that. But that actually is the fundamental innovation. It's not just about putting assets on chain, but it's actually creating liquid markets around those assets. And that's where price discovery happens. And I think fundamentally what crypto is doing is it's taking users, holders, and traders and actually collapsing those. There's previously more separate types of interactions and actually collapsing them down into one, because if you can have native financial infrastructure, that means that financial infrastructure, a wallet, access to finance is really at the same fingertips of anyone who's going to be logging into their email account, for example, or entering a search box. They can also participate in the financial system with equal ease. And so that really is, you could see that as a consumerization of financial services, or you could also see that as a financialization of consumer experiences. And I think that, but I primarily see that as the innovation is financial in nature, financialization of the consumer experience.
One of the big products that's been designed to, I guess, well, the initial intention was to bring more to the masses or more into the mainstream was the digitalized treasuries or DATs.
Yes.
Do you see that model being sustained just because it has come under significant pressure?
Oh, for sure. And we're in hangover from DAT season. And so crypto has always been a very, very volatile industry and subject to more kind of volatility and speculation than many other asset classes. That is true, and that happened at a very large scale last year. So there's an irrational liquidity window that occurred in probably about August and September, and everyone came into it, right, on both sides, the supply and demand for DATs. And I think that it's going to be tough, and like any sort of speculative cycle, there will be folks that capture that moment and can build something long-term, and there will be those that are not able to build something long-term. The reason that we took a very hard look at DATs and thought that this might actually be uniquely interesting within the Solana ecosystem is for a couple of reasons. One is because there is native yield to the asset at about 6%, and so that becomes a built-in yield mechanism that is important for DATs being able to accrue value. And then the other is that I don't think that outside of Bitcoin, because Bitcoin is like that's really captured. So Bitcoin is the asset, the infrastructure is the asset is infrastructure. So you can build a pure DAT just around the asset in Bitcoin's case. But then outside of Bitcoin's case, yes, you do need to have sort of you do need to have a value proposition around the core asset and asset accumulation, but that's not enough. You also have to be able to build, for example, operating businesses, be able to generate additional sources of yield that can bring additional value to that DAT, and those are the things that are actually possible to build on Solana. So you can both hold the asset, build a company on the asset, and also build a company on the infrastructure, and that actually becomes sort of synergistic and also compounding between the operating business as well as the underlying asset. So I think that's been the thesis for why I think there is an opportunity for DATs in the long term, but like anything else, who's going to be successful is going to be based on quality of strategy, execution, no different from other businesses.
I wonder though, as a foundation, my understanding is that the Solana Foundation has worked with a number of different DATs offering the token as well at a discount. Do you see that putting even greater pressure on prices essentially?
No, I mean, we've been very conservative in how we go about that, and I think that there was tremendous interest in doing DATs in the Solana ecosystem, all purely organic. And in a way, we thought that was a really great validation of how much interest there is, organic interest in the market in Solana. And so, we're really just happy to see that groundswell of interest and support. But really, what happened in the DAT ecosystem is organic.
Lily, great to have you with us. That was Lily Liu, the president at Solana Foundation. And Sherry, I'll hand it back to you.
The Annabelle Jewelers there joining us with that conversation from Consensus Hong Kong. We continue to watch the markets across Asia, especially one stock, Samsung, in the Kospi trading session today, because we are now hearing from Reuters that China's ByteDance is developing an AI chip and is in talks with Samsung Electronics to manufacture it. ByteDance wanting to receive sample chips by the end of March, and the company planning to produce at least 100,000 units of the chip, according to people speaking to Reuters. This is sending Samsung Electronics a bit higher. We had heard confidence coming from their executives on their HBM4 shipments, sending the Kospi up more than 1%. You can see MSCI emerging markets also hitting a record high. Indian stocks also recouping some of those earlier losses. That's it for Inside Horizons. Middle East and Africa is next. This is Bloomberg.